We're going to be rattling through some pretty fast stuff tonight. We're going to be getting through some bits and pieces, so I appreciate you joining us for these sessions. We're not going to be babbling on too much, but have you got anything else to babble on about, Kim, before we get started?
No, I'll do any admin stuff afterwards. Please spend good time with our good folks.
So welcome in, guys. I hope you're all good. We're going to be looking at the market makers for these sessions. We're going to be doing an hour or so sessions each night at this time for the rest of this week. We're going to be looking at what a market maker looks for, and the different trading styles, who trades where, what's the actors, who are the actors involved in different locations, and what type of style of trading. And we're going to be pulling information from a very well-known trader from the floor of Chicago, and that was a chap called Charlie D. You may well have seen his webinar. You may well have read the book, A Legendary Floor Trader. And we're going to be looking at some of the key elements that he talked about in his webinar, so that we can actually drive down into some of those key aspects and see whether we can figure out exactly what he was talking about. Well, the truth of the matter is it's very easy, because it's what every single floor trader learns when they step onto the exchanges. Remember, everybody keeps on putting these floor traders into this world of unbelievable traders. So the vast majority of floor traders were the same as every other retail trader. The vast majority of floor traders lost money and then left the floor. They weren't successful. They didn't make money. They blew their accounts and they left. And obviously the guys that were successful stuck around, obviously different from the brokers that were on the floor, the brokers and the clerks and everybody else that's on the floor, and obviously the commercial operators, the locals obviously being also one of the groups that made markets for people. So what was their process? What were they looking for? How were they taking the trade on? How were they taking their business? How were they doing business? And what were they looking for as traders? Well, we're going to be dealing with that in the next few sessions to try and understand a little bit more about the systems and processes. When we understand process, we're left with these arrows on the screen. Now there's 6 sell arrows on the screen from about 4 o'clock onwards London time. And you can see these 6 arrows are all in certain locations doing certain things. Every single one of them ends up with a very, very nice winning trade. Now obviously, why is that the case? Where did these arrows come from? That's the challenge, I think, for everybody to try and figure out where these arrows came from. In other words, is it possible in the right-hand edge of the charts to come up with these ideas? Well, of course, the question a lot of people have is, well, does anybody come up with these ideas in the right-hand edge? Is it all hindsight? And what is it about trading? You know, we've heard a lot of people talking about Fibonacci's, Elliott waves. Well, let's get through the truth of the matter, and we won't spend too much time on this because we want to get into the charts. I know you guys want to get into the charts, and I want to get into the charts. I'm not really interested in all the intro stuff. So when we think about it, what is it not? Well, a lot of people say, well, there's a big debate about whether it's fundamentals or whether it's technicals. Well, I'm sorry to say it's fundamentals and it's technicals. Fundamentals drive the markets on certain days, technicals drive the markets on other days. So I'm sorry, if you think it's one or t'other, it's not. It's simple as that. Patterns, well, patterns are not exactly particularly clever most of the time either. Pattern traders don't have a very strong track record. So that's not exactly the truth either, but there are some patterns that we obviously use to try and find opportunities to trade. What else drives the markets? Well, obviously we trade a lot of what we call R-squared trading. So it's all relative value, it's all statistical arbitrage, and we do a lot of that as well. Charlie D makes mention of this actually in the webinar, which you'll be able to find on YouTube, and Kim's posted a link to that webinar should you have any interest in actually watching it. It's about 2 hours long. The audio quality is pretty appalling, but you get a fair quality of information from that, and we'll obviously be drilling down, as I said, into that narrative. Building narratives, that's what's important. So the idea that the markets trend in waves, of course they trend in waves. They go up and they go down, and they sometimes go up a lot, and they sometimes go down a lot, and sometimes they don't go up much at all, and they just reverse back round, and they reverse, and then they start selling off, and so on. So the markets obviously trend in waves, but is it Elliott? No. Elliott didn't have basically a clue what was going on, and basically just made up some patterns to try and get people to recognize patterns. Well, good, because people always recognize patterns. I saw a very, very interesting little graphic the other day, and I thought it was worthwhile showing you this one as a pattern to try and understand a little bit about how the human brain works. Take a look at this little graphic here. and just cast your eye on the graphic itself and just see what it says and work your way through it. You will read this first, big, bold banner headlines, and then most of you, probably about 99% of you, will then look below it and it says, and then you will read this. And then you'll look below that and it says, then this one. And then all of a sudden you'll notice that there's some small print at the very top edge that says, and you will read this last. And sure enough, 99% of you will have read that very, very small print at the top edge last, because you're working through a process of pattern recognition. And pattern recognition is incredibly important because fortunes have been made in the markets by relying on people looking and spotting patterns like double tops, which turn out to be absolutely nothing. It's just a pattern that people recognize and have been sold into over many thousands of books on trading, and all the various algorithms and all the various indicators are all based around this idea of double tops and double bottoms. Things like stochastics are based around that concept of divergence into these kind of areas. Moving average convergence divergence is based upon that divergence on these in terms of momentum, and it drags your eye to seeing things in a certain pattern that simply leaves you a sitting duck to traders picking you off when they know that everybody's in at the same price, everybody's doing the same thing at the same price area, because humans are trading patterns. They always have traded patterns. They work in the world of patterns. And why do they work in patterns? Well, psychologists have claimed, successful of course, that humans use patterns to make life easier for themselves. They recognize patterns of danger to keep people away from danger. They recognize certain patterns in behavior, and for example, dogs' behavior or groups of people's behavior to keep yourself safe. You recognize a pattern and you avoid putting yourself into harm's way. So if you went through that little headline there, if you did that headline and you suddenly recognized that you did do exactly what the headline suggested that you did, and as I said, 99% of people will do that process. They'll work from the biggest, boldest, and then they'll look into the finer detail. Well, you're obviously going to be open to certain patterns that the market provides you with, and that's obviously something you've got to guard against, is trying to fit the market into a pattern recognition. So that's the first thing. So the markets rely on patterns because it's about developing liquidity. It's always about trying to trap people in certain liquidity situations. Why? Well, because everybody needs liquidity. The big boys, the big dogs, as Charlie D referred to them, the big dogs, the big commercial operators, they need liquidity at tops, they need liquidity at bottoms, and they simply go looking to try and generate as much liquidity as they can. This afternoon in classroom, for example, in our normal classroom, we talked about fresh air trading, where we have a very high probability trade. We can simply pick out from the charts without using any other patterns except for simply fresh air. When we see fresh air, we can buy into or sell into the fresh air, and it gives us an edge in the marketplace. Now, everything we teach is about creating an edge. A lot of, as I said, when we first started in this classroom, there's huge debates about whether technical trading was better than fundamentals, and it's a pointless exercise. Technicals give us liquidity, fundamentals give us direction. It's as simple as that. Technicals don't give us direction. Fundamentals gives us direction. Technicals gives us liquidity that we can play against. We can find liquidity in certain areas. When we're looking at other things that Charlie D was talking about, I want to just highlight the 4 key ingredients that Charlie D mentioned as what you need to do to be a successful local or flow trader or market maker. Number 1, choose your market carefully. The characteristic of the markets is very, very unique. There's some markets that are very, very fast. There's some markets that are very slow. There's some markets that have a lot of volatility, a lot of stop requirement, and there's other markets that simply have stops of 1 or 2 ticks, perhaps. I'm thinking, for example, if you were to compare the likes of the 5-year Treasury note pit versus the Ultra Bond, you'll know exactly what we're talking about. The Ultra Bond, so much faster, so much more aggressive than the 5-year Treasury notes. And you get this idea that selecting the right market for you is very important. And I'm also a great believer that you should select a market that you actually genuinely have an interest in. If you love politics, if you love economics, obviously things like the bond markets is a great market to get involved in. If you love geopolitics, the oil market is obviously an incredibly powerful market to get involved in. And why is that important? Well, we've seen in our own classroom over the last few months an awful lot of people missing out on what the main driver of their market is. One of the things that we always ask people to do when they first come into the class is ask one very, very important question. What is driving today's market? Is there a fundamental storyline? Is it something happening in China? Is it something to do with Taiwan? Is it Ukraine? Is there a storyline on the Nord Stream gas pipeline? What is it that's driving today's markets? And whatever's driving today's markets is obviously something we have to pay attention to, because whenever that storyline changes, the markets ultimately change with it. On days of non-farm payrolls, on days of CPI numbers at the present moment, we know that they are going to be big drivers. And we start watching things like interest rate curves to try and understand a little bit about how much influence these have in terms of other markets, like the S&P, for example, is very, very, very sensitive to inflation at the present moment, as you well know. So when inflation starts cooling, when the market looks as if it's actually starting to drift off into potentially recession, we suddenly see the S&P is catching a very, very strong break to the upside, and a lot of people can't really reconcile why that takes place. So choosing the correct market for you is very important due to the nature of the markets, the timing of the markets, where you're located in the world as well, and of course the volatility. What kind of size of account have you got and are able to trade? Taking a trade in the first place, this is probably the single biggest thing you can obviously understand, is taking a trade, because taking a profit and taking a loss are only going to be important if you actually get into trades. Good trades, high quality, high probability trades, they're only going to be important if you can achieve that. So taking profits and taking losses are something to learn down the line when you know how to get into a trade in the first place. When we bring an intern into the desk and we start asking them to get involved, the interns fall into very, very clearly two separate categories. The ones that simply just get into trades, and the ones that simply try and avoid trading. They always have an excuse. They always have a reason why they can't get into a deal. And you might find yourself in one of those two categories. You might find yourself getting too many trades and over trading, or you might find yourself constantly reluctant to take a deal because you're scared of simply not knowing enough. There's fear in the trade. You don't know enough. So how can you possibly put live money at risk on this trade when you simply don't know whether it's right or whether it's wrong? So therefore, it's very, very important for us in our classroom to understand that everything we do is based upon one single core concept, and that is value. Everything we do is about value. But inside that world of value, a lot of the ways we assess value is sometimes through structure. And obviously, value is only important for us as commercial traders if we can get liquidity on a trade. If I have a vast amount of value in a short oil position, but I can only get 5 buyers to buy into my sell order, then the amount of value that I get out of that trade is very minimal. And obviously my job is to try and force more buyers to come into a top edge so that I can get short against their buying. In the olden days, one might call it a spoof. Obviously, people now suggest that spoofing is illegal. Well, obviously it happens every single day on pretty much every single candle. Buy side and sell side liquidity is always moving about dramatically, and obviously most limit order book liquidity is false. It moves. It doesn't mean it's necessarily a spoof, but it's all part of that game that takes place in the background. When we look at value, we can look at something like crude oil, for example, and I'll show you some of the value narratives that we have been developing. In fact, if we look back at crude oil just in the last day or so, these trades are all based on our kind of automated system that we're developing just now called Max. And when you see them, you'll be able to understand exactly how this is evolving. The blue bands are buy-side value, and the red bands or pink bands, whatever color you see them, are sell-side value. This is on a 1-minute chart. And you can see this from 3 o'clock this morning. These don't repaint. They're real time, and you'll be able to see these. A lot of the guys have seen these in the room, and we're developing out this process so that we can bring it to you. But this looks for institutional real value. It's not anything in terms of price action. It's not anything in terms of locations. It's got nothing to do with volumes. It is just simply R squared. And when we look at the idea of statistical arbitrage, this is when we find real value. Now, obviously, you might argue about some of the entries and some of the processes, but you can see that we are buyers in this one at 3 o'clock this morning, and the price went up. We started to sell into this one. It didn't do very well, actually. We only dropped a little bit, and then we sold the top edge, and it dropped. We bought into the bottom edge, it went up a little bit, and we bought into the bottom edge again, and it went up a little bit. We bought into the bottom edge a third time, and it did finally go. Now, these are pretty big trades. These are 40-tick winners on a 1-minute chart, going from 4:10 till the back end of 5 o'clock this morning. So bearing in mind this is this morning's trades, we can obviously see how these trades played out. And if we just scroll along to the right-hand edge, you'll see exactly what happened. We're not missing out any trades. You can see that this buy trade went from 89 evens to a high price of 89.70. So we've made 70 ticks on this buy trade. So the idea is we're always hunting for value. We're always looking for value. And inside that value, we start recognizing some of the structures. And I want to come back into the structure narrative as we go through this classroom today. So where did we end up today? Well, you can see what happened. Eventually, that buy trade ended up way up at the very, very top edge. And one of the things that happened at the very top edge is you'll see that we had a couple of trades developing when the chart catches up for us here. You'll see that we had a couple of trades early into the Brent market open this morning. You'll see we had a sell trade at 89.85, the price dropped. And then we had another sell trade at $90.10 this morning. And you can see that that sell trade at $90.10, the price started to jam up into the top edge, the price started to drop out, and you can see what's happened since then. You can see that that sell trade itself resulted in, well, you can see for yourself, it resulted in an enormous drop-off in the price of oil. You can see there's no particular buy trades that generate when this trade reaches the bottom edge. Unfortunately, there's no buy trades that generate, but we went from $90.10 to $87.30. So you're obviously looking at a trade there that was just shy of $3,000 per contract using R-squared narratives, using this concept of R-squared. Now, inside of this, there's an awful lot of structural opportunities for the locals to take part in. Now, this is a commercial trade. This is a commercial trade. So this isn't something that the Charlie D's of the world would be getting involved in. This is something that the Merrill Lynch's or the Goldman Sachs banks, the very big commercial operators in the oil markets like Goldman Sachs, this is the kind of trade that they would be doing. And obviously what is going to happen is the market makers are going to start detecting this narrative. They're going to start understanding that this is what's going on. And when we stop a second to go back to understand the actors and where they're located in any particular chart patterns, we can start to understand a little bit about how this trade evolved. From this narrative, you can see there hasn't been any more buys or sells. You can see that Max has been very, very quiet since then. There was no bottom edge buys. There was no top edge sells. There hasn't been any other trade since then, so it's been pretty quiet. So there's no point in me going back over any of those elements. So the one thing we wanted to touch on before we get started is, of course, the actors that are involved in the charts. It's very, very important to us that we understand who deals where and what their mode of operation is, what their modus operandi is in terms of how they trade and where they trade. Now, it's fair to recognize various groups in the trading world. It's fair to recognize that we have several groups. They all have different types of trading, but let's just group them. We have commercial operators. The commercial operators are what you sometimes hear in the olden days as paper buyers and paper sellers, the big outside money coming in. So this is somebody that's buying because they have a big commercial order to fill, perhaps. That's a broker side of it. But generally, as a rule, this is big commercial paper coming in from outside, somebody who's not on the floor of the exchange but phones in the orders. We're wanting to buy 1,000 contracts of oil because we're getting into a big oil position, or we want to try and build a very strong, a very large steepener, for example, on the 2s10s. So we want to buy into a very large bond position at certain prices. So this commercial paper, that's the first main group. The second, of course, is the group that we would then classify as the HFTs. The HFTs we can also group as prop desks, because the HFT and the prop desks, of course, these guys are going to be trading in most cases. They're going to be taking some of that risk over from the commercials. Now, the other guys in the middle, of course, are the market makers, the floor traders, the market makers. So we can obviously group this third group here. Now, retail traders have a choice about where to deal. The interesting thing is, most retail traders think they trade like the HFT world. They trade like prop desks. Most retail traders don't trade like prop. The vast majority of retail traders, through various studies done by many different brokers actually, end up trading more like commercials. So they'll get heavy long when the price is dropping, and they'll get heavier short when the price is rising. Perhaps you recognize that from your own trading. It's a very bad habit to try and get out of, is trading like a commercial. Now, obviously, because of that, as I said, most retail traders trade like commercials, and because of that reason, they don't have the same depth of market as commercials. They don't have the same ability to defend positions or average into a position. Most people would call it martingaling. Commercials just call it building a position, right? So it's the same for retail traders. It's martingaling because it's got an enormous risk. For commercials, it's just normal business practice, is building a position into a certain top edge or bottom edge, because they're not outright commercial. They're just simply perhaps hedging a position so they can sell more at higher prices without any trouble. That's why a lot of the times when you hear somebody talking about commercials, you hear them talking about commercial hedgers. So there's obviously a hedge, there's perhaps a spread attached to that commercial position. So let's think about who trades where and what is their mode of operation. So let's work our way through. We'll just draw a basic random chart, and it won't be that random because we're wanting to highlight some of the elements that come into the markets. And one of the key aspects that we're looking at when we're looking at trading is the speed of movement, obviously, the toxicity of the markets. We'll be touching on that in classroom today. And we start to look at various responses to certain other elements. We start looking at other responses. We start looking at where the market responds. And I'm just trying to be as random as I can without making it too obvious during this process here. So who trades in different locations? Well, it all depends, of course. If I'm looking at something like R squared, if I'm looking at some value that we know is a very, very large driver in the market, so for example, if it's interest rates, and I draw a line on the charts and I say, right, well, that's when the market's bearish and this is when the market's bullish, who trades this? Well, let's deal with that. Commercials trade value. Every commercial that buys or sells a market is buying or selling a market because of R squared, the concept of value. No commercial ever buys a market because they think it's bullish. They buy a market because they think it's cheap. They think it's got value in it. So in that type of environment, they're going to buy into that as a storyline. So obviously, when we're looking at this, we've got to try and think about who trades and where do they trade. Let's think about the prop desks first of all. And I'll color the prop desk screen. It doesn't mean they're buyers or sellers. We'll obviously explain what they are when we color the prop desk HFT trades. So during this leg lower, when value is lower, the prop desk will obviously be selling. They're going to be selling down into this area. So the prop desk are going to be working shorts. They're going to get jammed at a certain price. Normally that's got a bit of volume attached to it, and then they'll stop selling. The price rallies back up, the price rolls back down, and the prop desks start coming back in again. The algorithms start coming back in and they start selling down into the bottom edge. And a lot of the times you'll see on these drops, you'll see what we call aggregation. It's just a volume, a confluence of buyers and sellers meeting into these prices. We normally see an increase in volume, and it just stops the price, perhaps temporarily. And then the prop desks sell into this again. They sell into this again. And they sell into this again. And they're just going to keep selling into this because until they get the nod, until they start recognizing perhaps some sort of activity by the commercials, they're just going to keep selling it. Just like everybody else, these algorithms do not have a particular view of whether the commercial should be buying or selling. They're basically waiting for it to happen. So when we come down into the bottom edge and perhaps the commercials start coming into the bottom edge, the algorithms are starting to recognize, wait a second, what's going on here? They start selling into this deeper pullback. They start selling, and all of a sudden they get jammed. And then all of a sudden the algorithms say, wait a second, no, these guys are crossing the spreads. The commercials are crossing the spreads. And obviously what happens is they stop doing any business. They're not willing anymore, perhaps, to do any business on the sell side. The commercials are now crossing. And what will happen is that the commercials start bidding across the spreads. They start bidding up the price. It's a markup phase develops in the market, and the algorithms flip sides, and the algorithm starts saying, right, I'm now a buyer in these areas here, and the algorithm says, now I'm a buyer in these areas here, and the algorithm says, now I'm a buyer in these areas here. And that's what most retail traders think they do, but it's not. That's not what most retail traders do. They don't follow the pattern of HFTs or prop desks. What most retail traders do is they try and be the commercial guy. They try and buy on the downticks. So when do the commercials take place in this trade? Where do they take place? Well, they originally will take place on the downticks. Commercials will buy on downticks. We know this from the COT report, for example. So you don't have to take our word for it. You can actually see for yourself that the commercials and the speculators go in opposite directions. And this is their reporting of their positioning. So it's not up for debate. It is the way it is. You can prove it to yourself by looking at the COTs. So a commercial will buy in here, for example, but not to get net long. It'll buy in here to take profits on a short position. The commercial will buy in here, not to get net long, but to get profits on a short position. And the commercial will do the same here. And they will close off their position here. In most cases, why? Because they will have lost all their value. They want to close out their positions. So now when the price drops down, the commercial is effectively flat. They're trying to turn their position round now, and they're wanting to get net long. So a commercial will see how much selling's coming in, and a commercial will get net long off of these price areas here. A commercial will get net long here, and then when they see that there's absolutely no more selling coming in, because originally there was some prop selling, there was some algorithmic selling, when they realize there's no selling, a commercial starts crossing into the spread. And obviously when the commercial starts crossing into the spread, we get what's called a top right-hand hold. And obviously the commercial then presses the market higher, and then the algorithms take over and the price goes. And as the algorithms take over, the commercial does what? Well, we know what the commercial does. The commercial starts taking some profits, of course. The commercial comes in and takes a little bit of profit as the price rises. It takes more profit when the price rises, and so on. Now, we've marked off the HFTs and we've marked off the market mayor, we've marked off the commercial paper trades. As I said, most retail traders obviously trade like commercials, but they trade like commercials really badly. We did an exercise, but they trade like commercials really badly. We did an exercise many times over the last few years of trying to get people as close to as possible to where the commercials may be dealing. It's basically the lean that you get from your order flow charts. But most retail traders, when we first started with retail traders in the, many decades ago, when we first started with retail traders, what they were showing us was basically that they were waiting for things like candle confirmations. So they waited for a big red candle to reverse, and then they would buy into the move. So obviously, if I was to look inside some of these patterns, and I was to look at, for example, this drop here, and there was a sell candle and another sell candle and then another sell candle here, and a retail trader was looking at it saying, oh, the price is going up, and they waited for the opportunity. They would probably try and get in when they got this candle reversal here. And that's where they would be buying into this. What a terrible, terrible trade. Because what happens in most retail trade examples is very, very simple, very, very straightforward. The retail trader, if they're trying to buy into this phase, will ending up buying at this price. What happens to them? They get stopped out. They'll end up buying somewhere here, and they'll end up getting stopped out. They think they're on the right trade. They'll end up buying in here, and they'll get stopped out, and they'll go, what a second. I've just been stopped out for a full stop out 3 times in a row. I don't know what I'm doing wrong. It's because they started to buy too soon. And even when they buy with value, and they come into this classroom and they start buying with value, they say, I bought with value, great. And they've just bought in here. And then they get stopped out. They're now annoyed at the fact that, well, I had value this time. Surely to goodness, I should have made some very easy money. What the hell happened? Well, what did happen? Well, simply you overpaid for that trade, didn't you? You massively overpaid for that bit of business. So they come back in and they say, right, I'm going to try it again. And they get in another trade, and all of a sudden they get stopped out for a break even on this occasion. And now what is their success rate? So they bought here, they lost, 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 they bought here, and they scratched. And now they're sitting with a 5 losers, 1 scratch. And they've even done the course. And they've got 5 losers and a scratch. And the first thing you recognize is that they were buying into selling. They were buying into sell-side supply. And that's obviously never going to be a winning trade for them. And then when they get the demand coming in, when they get that blue line rising, they're simply not getting the right price to buy into. And as a result, they're still getting stopped out. So one of the biggest challenges, of course, then comes down to simple execution. Where should you buy and where should you get involved in a trade? Well, when we do the Monday Club exercises with our standard Monday Club, but which we do every single Monday, of course, which is why it's called the Monday Club. The idea is to try and get accurate to within about 2 ticks or 3 ticks of the price turn. Charlie D mentions this when he talks about transition trading. Learn to trade the transitions. Learn to trade the transitions. Now, what's a transition? Well, a transition is when we know it's a buy trade, and as soon as we see it turning into a buy trade, we're in it. So, for example, into this buy trade at the bottom edge, you might want to wait because it's not formed properly. There might be still quite a bit of selling in here. You might want to wait. But as soon as we see a sell coming in and it stops and it reverses, we want to be in a buy trade there. We want to be in a buy trade there. We want to be in a buy trade here. We want to be in a buy trade here, so that we're not at the bottom edge. We're not trying to call a bottom edge. We're simply joining in when we know the bottom edge is the deal. We're joining in when we know the bottom edge is a deal. We can get a stop at 3 or 4 or 5 ticks, and we are not giving away our whole advantage to the upside. Charlie D talks about this when he talked about the buying opportunities. He was talking about, for example, that there was a big opportunity to buy into the markets. And if you just constantly paid across the spreads, you were never going to make any money. So you've got to know when and where to try and take these trades on. You've got to know how to take these trades on. Now, the downside for us as educators is that a lot of you guys have different types of platforms. Some of you have NinjaTrader, some of you have TradingView, some of you have Sierra Charts, some of you have a combination. So you have access to different levels of tools. And obviously some of the best leans are perhaps something that you see in the order flow charts of NinjaTrader. So for example, that, if you remember, the first chart we showed you was that huge opportunity to sell some oil. You can see that if we were to use NinjaTrader, one of the questions was how close could we get to a NinjaTrader reversal? Well, the answer was very, very simple. We managed to get this little voltic dot just here, which is the volume of the tick kicking off in the background. So we get all these voltic dots. We get a big lean in the background here. We get some refreshed order book, hence the red little triangle. So we're getting what's called a refreshed order book. You can see at the very bottom panel here from MZPAC, you can see this withdrawal of liquidity on the bid, an adding of liquidity on the offer. So there's a migration of liquidity in favor of the sell trade. And we've got a lean that we can simply lean against on oil with a 4-tick stop. Well, that's a 4-tick stop on a trade that went for nearly 300 ticks with a 4-tick stop. Now that's pretty good because it's not nearly at all really, but it's over 50 to 1 return on your money. So depending upon where you took your profits, you could have easily made 50 times your money on that trade if you were risking 2%, for example, or simply you had a very, very small stop on this oil trade. So being able to recognize the transition, being able to recognize when to trade and why you're trading and where to trade, we can simply start putting some of these massive opportunities into your charts. Now, obviously, we've done many examples of screenshots of trades that we have tweeted out and taken. A lot of you guys will be aware of the Twitter that we have. But I want to come back to that before we get into the actual exercises themselves, because it's really going to be getting to do the exercises, learning the interns exercise, challenging yourself to see where those arrows came in, and then being able to replicate that over the last 2 days of this 5-day classroom series. And that's what we're trying to get to through this series. So we've talked about the commercial paper, we've talked about the HFTs, we haven't talked yet about the market makers. What is their mode of operation? Well, their mode of operation is to adjust liquidity to try and take advantage of the trades. Now, by adjusting liquidity, of course, what they're trying to do is avoid getting destroyed. That's basically it. The market maker is a passive trader 99.9% of the time. It's taking the other side of what anybody else wants to trade. And we can understand that the market maker's mode of operation is, if there's a lot of heavy selling, the market maker is going to be very, very long. So the market maker has to avoid getting very long. So the market maker withdraws liquidity to try and put off the sellers. So in this type of environment, in the first drive lower, we could probably understand that the market maker is withdrawing liquidity here to avoid getting too long during that period. Now, why do they want to avoid getting long during that period? Because R squared is sell side. They don't want to deal, they don't want to build a long inventory at this stage. They want to build actually a short inventory. So when the price comes back up, we can understand when the price rallies, they want to actually try and get net short, which is the very, very simple mitigation trade, which we use VWAP to show you some of these ideas, and we'll obviously do that again in this afternoon's classroom session. We'll show you this mitigation price area so you understand where it is and why it is. As the price drives again lower, the market maker doesn't want to get any of these positions until they think they've got an edge, and then obviously it pulls back and they get net short here, or they simply clear their long positions for a small profit. And again, the same happens here, and they do the same here. Now that's obviously whilst the market is bearish, and the market maker knows this because the market maker knows who they're dealing with. So in other words, if you were on the floor of the bond exchanges, if you were on the CME or the CBOT, and you're looking at who's buying and who's selling, and you're doing the other side, you know who they are. You know whether it's the guy at Merrill's. You know whether what that guy does. Does this guy trade for the Merrill's own account? Is he a prop trader, or does this guy trade the big commercial orders coming through Merrill's? You know what the guy is that's just done a big treasury trade. This guy nearly always trades the knob spread, for example, the 10s/30s. So the guy that's doing the big trade on the knob spread is doing a big trade because of the spread, and therefore is not necessarily directional at this price. In fact, maybe counter-directional because it's a knob spread. You know who that guy is. You know that they're doing a 10,000 spread. So you can obviously recognize what their actions are likely to be in the market that you're trading. So in other words, the market makers know. So if this is a guy that's buying 30-year treasuries, and you know that that guy is part of the knob spread, then if the guy's buying 30-year treasuries, you'd be delighted to sell to him, correct? We know that as the Grail trade. We know that as the very, very obviously, very aptly named Grail trade. It's an incredible way of making money in treasuries. So we know what that guy's doing. We know who he is. We know what bank he's from, and therefore when we take it the other side of the trade, we're doing so willingly. The guy's not bullish bonds. We obviously can understand that they buy as part of a spread narrative. So when we understand this, the market maker obviously has the ability to add liquidity and pull liquidity from different sides depending upon what's happening. The other thing about the market maker is they want to do business. They're always connected. They're always taking something. But if you think about it, a lot of people kind of get this mistaken about how a market maker makes a market. Well, you think about a starting price. Imagine this was the bid offer spread here. This is the best offer and this is the best bid right here. So we've got the best offer and the best bid. Here's the best offer here. Here's the best bid. Now imagine you're sitting on the best bid. You're making a market, and a big commercial seller comes in. And the big commercial seller comes in and they take your bid price. They say, right, what are you doing? You say, I'll give you 60s for 50 contracts. The commercial says, done. Okay, so you've just sold into this market maker's buy. The market maker now knows that that commercial is a seller. So because of that, the market maker will pull away their best bid, and they might leave their best offer in place. They might do that very simply, very quickly. They'll pull away their best offer. Sorry, they'll keep their best offer and they'll pull away their best bid. Now, what happens to the price? Well, obviously, what happens to the price is very, very straightforward. If anybody wants to sell again, they'll be selling at the lower price. So what happens to the chart during that period? Well, the chart starts to look like this, doesn't it? We get a big red candle. So as the market maker pulls away the best bid, we get a red candle. Well, we can see that taking place on every single chart, on every single time frame. We can see a red candle. In fact, we've done many exercises in the past when we talked about the market maker's process, so that people understand properly the market maker's process. We did an exercise to show how you can actually mimic the market makers by adding a volume narrative and simply trading it like the market makers. And in fact, over a period of about an hour, we made several $1,000s simply by being the market maker during that exercise using a very simple, very objective set of rules. Now, I don't recommend it because it's obviously relying on you having enough volume to trade like a market maker, but we'll do that exercise this afternoon as well. Okay, so now we know how the trade develops. We now know how the commercial paper trades. We now know how the HFT prop desks trade, and we now know how the market makers trade. They're taking the other side and they're moving liquidity about to try and avoid taking a sore trade. They'll go lower to close off sellers. They'll take the market higher to close off the buyers, and that'll allow the algorithms, the HFTs, to basically drive the market high enough until the commercial sellers take a genuine interest in what's going on. So let's have a little think about what we can see on the charts. Let's go back now to the market makers exercise, part number 1. Now that we know what the market makers exercise looks like, the market maker buys on big red candles and they sell on big green candles, we can obviously start to understand the idea of what a big red candle means. The market maker has been able to recognize a big commercial seller coming in, they've pulled away their liquidity, and they've dropped the price. So in other words, that causes a situation called toxicity. We can see a couple of toxic candles on this chart itself. I mean, this is just going back over today's S&P charts. And you can see there's a couple of very toxic candles. You can see, for example, there was a very toxic candle came in just there. There's a very, very large red candle, and it seems to stop in the middle of nowhere and just reverse back up, but that's a very toxic sell candle. So obviously there's got to be some sort of commercial selling in the background, and we'll obviously develop out how to make sure you're recognizing these areas when you're diagramming your own charts. But let's get through the interns exercise first of all. The interns exercise is about understanding how to trade as an HFT, how to trade as a prop desk. The idea of the exercise is several faceted. It's not as simple as you might think it is when you first see it. The interns exercise is about trying to get people to stop fading. The natural inclination for even the youngsters coming onto a trading desk is to sell something when it looks as if it's expensive. Looks as if it's expensive. In other words, when it's towards the top edge of a chart, it looks expensive, doesn't it? The price has been rallying all day and it looks expensive, so it's easier to sell it rather than buy it. Well, that's always going to be a mistake, isn't it? There is only one top edge at the end of the day, isn't there? There's only one single top edge. It's made up of multiple hundreds of potential top edges prior. So obviously, the idea of selling a top edge just seems to be a bad, low probability opportunity. So how do we get people past that idea? We simply get them to recognize the interns exercise. And the interns exercise is something that every floor trader knows about. Everybody that's ever been a local on the floor of the exchanges knows that you're looking for commercial activity and you're looking for this concept which is taken from Profile, in fact, called the failed auction. And a failed auction is very, very easy to recognize from price action structures. Anytime we draw a chart, anytime we draw a narrative, we can obviously compare how far the sellers got against how far the sellers got the last time. So in other words, if this price turns back up towards the top edge, that was a failed auction. This market is still bullish. The sellers haven't been able to achieve the same price the last time. The buyers have come in higher than they did the last time. This market is bullish. And as a result, your job is to try and buy. We've got several entry processes, one called the tipping price, one called the BSG squeeze, and obviously the interns learn originally to buy into this simply by breaking out the top edge. Now, we don't like breakout trades. We hate breakout trades. They're the worst trades on the planet, but they're a great way to learn the process. It's a learning process. It's a drill. It's not meant to be your buy or sell trade. So the idea is that they simply mark off the highs or the lows following a failed auction. When the price breaks through that failed auction, that's a structural break. The market is bullish. When the price pulls back, that's now the high price that we're now paying attention to. Okay, so when the market breaks back, we obviously have two key references. We've now got the current high swing, and we've obviously got the lowest price, which was in the middle of the breakout trade right here. So the interns breakout trade here, we now have this low price here, which is the bottom of the buyer's auction. It's really, really easy. We've been training this in this classroom for the last 7-8 years. So everybody that's came in after this is obviously just copying this process, but it is a standard process. It's not my process. It's the process that's been in the locals world for decades. Nobody claims it. It's not somebody's invention. It is just what it is. It's the auction process that everybody knows about. So whilst this is happening in here, whilst this price here and this price here are still in play, the only trade you can take at this stage is to still be long the market. So it doesn't matter what else happens. The price may go up like this. The price may then drop back down again. This is still a long trade. So in other words, if we get a little grab of liquidity here and the price turns back up, we could be buying in here, we could be buying in here, we could be buying in here. There is no sell trade. It is only a buy trade. Because the only way we can ever get short is if we break that structural low. And what that does for the interns is a very, very powerful piece of information. It means they can focus on one side. There's an awful lot of very, very, very famous traders, some very famous locals and some very famous big investors that'll tell you that the secret to trading, and the secret to trading is this very, very simple fact. You may have heard about it, you may have heard somebody saying it, you may well have recognized it from somebody talking about trading, and you've never really fully understood what they mean by it. But basically, if you can eliminate one side of the market, you can really focus your time and attention on being a buyer. The ability that that brings is incredible. The benefit that that brings is incredible, because you're no longer thinking about whether you're a reversing trader. You're not trying to find the top edge sales. You're not trying to get short at any stage ever until something changes. Now, obviously, the idea of commercials, and we come back to this idea of the commercials' desire for one thing and one thing only, and that is liquidity. So the value might be incredibly bearish, but the commercial needs to get size on this. So in other words, when we look at commercials and we define what a commercial was looking for, volume and value achieved at price. So when we look at commercials, this is exactly what a commercial is trying to do. They're trying to get volume and they're trying to get value. Value without volume is worthless to a commercial. Volume without value is worthless to a commercial. So we need all of these elements. We need to get volume and value. So therefore, structures are developed until structures are broken. We obviously stay bullish in this market. So the value might be dropping hard at this stage, but obviously until this market turns, you're going to be left with trying to fade top edges, which is a difficult trade to start with. You're really wanting to stick with the long side of the trade. So obviously the market may well run stops at the top edge because the value is bearish, and it may drop back in, but that's okay. If we've broken the top edge again, then we have a new value line here. So this is something that we actually did an exercise with, and a lot of people struggle with this as a very simple narrative. So let's make sure everybody understands how to draw the charts in terms of simply just getting the structure right about one side of the market and one side only. For that purpose, we'll use the S&P. So this is today's S&P chart, and I want to just go back somewhere. You've got to start with something somewhere on the screens. So we'll start with that sell trade at the top edge, and there's a very strong reason why we're starting with the sell trade, because if you simply went with R squared, you were able to make a lot of money on these sellable opportunities. But let's just think about it. So start any high, guys, any high at all in the charts. It doesn't matter where you start. This is a 1-minute S&P chart for today's US cash open. So there's a high price just there. We can see that that high price gets taken out there. And obviously all we do at that stage is mark off the lowest low between the high price and the takeout price. Okay, so that's the two prices we're interested in. So we've got the high price there, and we've got the takeout price here. So we just simply mark off the lowest low between those two prices. And that is where a sell would take place. Not a price sell, not a trade that you would take as a sell, but that's where the structure would break. We would get this fundamental break of structure. Now obviously as the price continues higher, you can see there's a couple of testers into that area, and you can see it does go higher still, and it keeps going higher still. It drops back off and it goes higher still, and it kind of generates a couple of ideas in here. Now, this is when the reality meets the theoretical. Has the price gone higher? If the price has gone higher, we can start seeing that there's a lot of double bottoms here that do eventually break in here. You can see that there was quite a number of structures that get taken out, and the lowest low between those structures were this price here and this price here. So they're the same price. So the structure finally got taken out just in here. So when that structure got taken out there, this was the breakout of the structure, wasn't it? So where was the highest high during that structure? the highest high during that structure was now here. Now we are selling, and only selling. So what we're trying to do is we're trying to sell on upticks. We're trying to sell on squeezes lower. We're trying to get short. And obviously one of the sells we could use was this little, what we call spring trades. This is something that comes from many other disciplines. We could have taken a little short trade in there, and we could have taken a little pop at some sell side opportunities against this low print here. Now obviously what happens is you can see that that sell generates some really nice downside. Now obviously this is a pin rejection. We never get a single close below here. So when we break structure here, we can obviously recognize that this was the highest high. Where the sell arrow is here, that was the highest high that had been achieved. So obviously the highest high becomes the breakout structure for any additional buying that's going to come into the marketplace. So what happens next? Well, if we get up into that area and we break and we get a nice close above it, the structure has changed into a bullish structure. What happened? We got a sell opportunity, not a buy. We got a sell coming off that structure high. Now, why are we still selling the structure high? Why are we actually still selling into that structure high at that stage? Well, we're selling still into that structure high because we haven't broken the new low price. We're selling still into that structure high because we haven't broken the new low price. The new low price is down in here. So we haven't changed that narrative, have we? So anything in this area, anything in this area is a sellable opportunity. So any higher highs, any aggregations, any absorptions, regardless of how you find those things, whether you're using order flow or volume spread analysis, or simply using a concept of a higher high price, which we obviously can see in the background. We get a higher high in here, and the close of that candle could have given you a very simple sell trade. And obviously you could have used the reversal of that candle. If you wanted to get into the late to the party narrative, you could have sold the red candle there. And obviously that would have given you a structural sell back into this value. But it's still a sell trade, regardless of what you use. So obviously selling into that, you're obviously going to be targeting to take out the low price. But obviously it hasn't taken out the low price, so this structure remains. It's still a sell trade. It's only one-sided. You've eliminated the buy side of the marketplace, which actually is pretty good, because when we look at R squared, and obviously we have many different ways of analyzing value and analyzing R squared. If I look at, for example, what we call R squared, this is what R squared might look like. You tell me whether the market is bullish or bearish. This is real time, by the way, not lagging, of course. You tell me if this line is bullish or bearish when we get that sell on the charts. Just imagine this was a stochastic. Just imagine this was a MACD. You would be looking at that divergence and you'd be jumping all over like a crazy, wouldn't you? You'd be looking at that saying, my God, I've got a structural sell and I've got R squared value. I've got relative value in that short trade at the top edge. But if we don't know where relative value is, it's still getting a short trade. Right? We're not needing to see that relative value. The relative value improves our probabilities, and it's something we teach as we go through the course. We start recognizing, but until you've actually even got to the decision of making the short trade in play, then of course you wouldn't be trading this otherwise. So you can see there was no sellable opportunity here. There was no sellable opportunity here, and there was certainly no sellable opportunity here. We hadn't generated value, had we? The idea of generating value inside of these narratives becomes straightforward when you see what happens next, of course. The value stays very, very short. The market stays very, very nicely in that narrative going forward. And you can see we get another pullback sell. And again, we still haven't broken structure. So we can see that on the basis that we still haven't broken structure, we get a little break higher here. Now, why were we selling this candle? It looks very cherry-picked, doesn't it? And rightly so, a great question. Why did we sell the top tick candle? Is it because we knew it was a sell, or because we simply knew we were coming in to do a classroom? Great question. In the markets, a lot of people have heard of a thing called Fibonacci extensions. Well, they're a load of bollocks, basically. I mean, I think everybody understands that they are a load of bollocks, but they're not actually. Without use, the idea that the market somehow magically stops at 1.6 or 1.3 is just ridiculous. Imagine a local, for example. You put yourself on the floor of the exchanges, and you've got to try and calculate these percentages. Does that happen? Of course it doesn't. It's just preposterous to even think that the locals are calculating out what 1.6 as a measured move against a particular move gives them as a trade. So it's a load of rubbish. But the idea that the market extends, the idea that the market moves in these kind of ideas is absolutely 100% accurate. It's just not Fibonacci. Fibonacci was just some way of selling ultimately a lot of courses based on some guy that was able to recognize the breeding habits of rabbits. Fibonacci doesn't work. It never has done. There's no algorithm out there that trades Fibonacci that's generating a positive return. So when we understand that Fibonacci simply just doesn't work, what does work? What do the locals use? Well, the locals are a relatively intelligent crowd. At the end of the period of the floor of the exchanges, we got a lot of PhDs and a lot of degree students in there. But in the early days of the floor, it was pretty much a whole wad of retail traders going in, basically, who had enough money, who are well supported initially, and they fancied their chances in the new wild west of the bond pits or the equity pits or the gold pits or the oil pits. These weren't quants. They weren't simply math graduates. They weren't PhD physics graduates. They were simple guys that used to sell engine parts or typewriters or photocopier machines who fancied their chances in the markets. In other words, they didn't have this type of tool set. They didn't have any interest in this type of tool set. The simple way that the market makers and the dealers and the floor traders understood the markets was they had tickets. You probably see them if you look at any of the old videos. They've got sheets of paper, and you can see them writing things on sheets of paper, sometimes on the front of the paper, sometimes on the back of the paper. What is it they're writing on the back of the paper? A lot of them are taking notes about where the highs and the lows of the swing are. In other words, if I said to you the high of the swing was 10 and the low of the swing was 5, there would be an automatic idea that, of course, the highest high is going to be 15. Why? Well, the lowest low was 5, the highest high was 10. It's a 5-tick range, it's 5-tick volatility, therefore the high is going to break by 5 ticks. I'm going to simply do a measured move to the upside by 5 ticks. What? Seriously? Is that all it can be? Seriously, the guys that are in the room who do this every single day will tell you the incredible magic that this actually brings. It's not a surprise. It's actually quite magical in its properties, and yet it's simple floor trading techniques. So for example, when we start measuring a particular move from a certain point to a certain point, we can simply start looking into this and saying, right, well, we've got a failed auction here. And if you look in the background here, I can see that I had a failed auction here. Well, the floor traders are going to look at that failed auction just here where I've put the sell arrow. They're going to look at that failed auction and say, where is the sell opportunity based on that failed auction going to show up? You get your Fibonacci tool, and it's called a Fibonacci tool because everybody knows it as a Fibonacci tool, but you get rid of all the stupid Fibonacci numbers. They mean 0, and you replace them by 1 times and 2 times and a half times. That's it. You simply replace them by 1-time projection, 2-time projection, and half-time projection. Okay? So what does that show like? Well, if this was the high price and this was the low price, can everybody see the area? Now, we trade in areas. We don't trade in pinpoint accuracies. We can see that in this area here, there's going to be a sellable opportunity in that area. See the little top quarter? That's where the locals are going to start selling. So for example, if I see this drive higher, you might say, how did you know that that was the sell price? Well, if that was a high price that the local knew about, and this was the failed auction here, and I said to you guys that you're going to trade in this area here, how does that area sit as a possible tradable opportunity? Are we using something that's dead obvious? It's Fibonacci. No, it's not. It's got nothing to do with rabbits. It's simply to do with the fact that the high price was 79s and the low price was, say, 75s. And if the high price was 79s and the low price was 75s, you're looking at that and saying, what's the difference? 4 points. Okay, so I'm going to be selling at 83s. So you know you're going to be selling at 83s. Do you see how easy that was to find? So there's 83 right there. You're going to be selling at 83s. So you start watching 83s. It doesn't mean you just jump in at 83s. You start watching 83s for that simple, easy money short trade. We can obviously find a lean against it. We can see other people selling at that price by finding an absorption print. And we can lean into that 83 print as a seller. But the structure has to still be short. Remember that. The structure has to be short because obviously for the structure to have broken south, there must have been commercial selling coming in the price. So we're keeping ourselves safe, but we're not giving away the edge of the commercial seller. We're not giving away that edge for nothing. We're still short. Now, obviously, if we added, as I said that before, if we added R squared back into this, you can see that we have a lot of value on the short side here. You can see there's no way in a million years we'd be buying the bottom edge anyway, so we know why the commercial is selling. Something incredibly valuable to trading. So when we come back up and we start selling into this, where's the target price? How do we work out target prices? Well, the previous low is always going to be a target price for a multi-lot trader. So the first target price is dead obvious. So if we've sold a high up here, for example, you can see that our target price is here. It's not the breakout of the trade. It's a couple of ticks before the breakout because we want to make sure that if the price gets buyers coming in off that previous low, we simply don't give away all our sell side profits and we take our first bit of profit in that area. Remember, this is not a sell trade. This was just an arrow to illustrate that what we were trying to do in terms of where the sell was located. As we come away from this as a narrative, we've now got bracket highs, we've now got bracket lows, and we understand this because we start asking people to start generating some narratives. We start asking people to generate a narrative. What is a narrative? A narrative is the story. What is driving the marketplace? And when we start asking the story about what's driving the marketplace in terms of structures, these narratives become very, very valuable. So when we see a bottom edge like this forming, we start recognizing that this is what we call a cap buyer. So we come into the bottom edge and we can see that this becomes what we call simply a cap buyer. Now, why is this important? Because when you start to learn about market delta and tick delta, you'll start to recognize that an awful lot of market delta selling gets absorbed in this cap buying area. The reason why that's happening is, of course, to try and tip the price over. In other words, the concept of pump and dump is probably well known to some of you. So what's trying to happen here is we're absorbing the selling into the lows. Everybody knows it's a short. So what we've got to try and do is get some of those sellers to puke their positions at higher prices. Hence the reason why the price goes up into this puke position here, and hence the reason why it goes up into this puke position here. It's to try and get some of those sellers at the bottom edges who all know it's a sell. They know it's a sell. They're selling it hard to just give up on their sells because they can't take the pain of the sell. It's maybe an algorithm that has a lot smaller stop. And obviously that gives us a couple of ideas. Now, where does the target price come in? Well, we go from the cap sellers to the high of the bracket, and we simply look for a target price. When we look for a target price, this is something that gets preceded, we get updated. So our initial target price was here. Now that was our original target price. Every time we get a new sell coming in, we revalue, we reassess what our target price is. It doesn't mean we're going to take our trade out here. What it means is that when we come into this price, we're going to be aware of it. Now, obviously, as we get to learn a little bit more about these structures, you'll understand why this is a trade area here as well. So what this trade here is, of course, is what we said, the seller's pending. There's a very simple reason, because that is a break of structure. The sellers are going to come back in at this price, and we know that we should automatically be trying to sell into that price area. Again, we can look at our value to see how R squared is developing, and we can see the R squared is still very sell side indeed. And we simply keep projecting further and further into the future to try and keep this sell going for as long as possible. We are pressing our sell side business. We're trying to press this on squeezes, on tipping prices, and we end up getting a very, very nice drive to the downside. As we go through this process, one of the things you start recognizing is as you project out some of these areas, you'll start to see other things starting to form. You'll start to see confluence of areas. You'll start to see if I come down into that area there, we start recognizing some other confluence. So we're basically taking that and we're now projecting 2 times. And there's the projection at 2 times just in there. Now, when we move into a 2 times projection, normally what we find is we see a very large aggregation taking place. Aggregation is simply an awful lot of profit takers all coming in at the same price in the same area, doing the same things as we reach up down into these areas. And normally the pullback is going to be a lot bigger. Normally in this area here, we'd see a big surge in volumes. If you look at the volume charts, you'll see there is an enormous surge in volume in that area. Do you see it? Huge, biggest volume of the day. Into that volume area just there, you can see that huge surge of volume. And isn't it interesting that it's at 2 times the measure? It's nearly always at 1 times the measure or 2 times the measure, nearly always. That aggregation always seems to appear. Now let's go back to the interns exercise. We said that we would try and drive through this without trying to miss out too much stuff, but we want to make sure we get something out of this. Okay, so now we understand this idea of eliminating one side of the marketplace. This idea that by breaking structures, we are starting to find our way into sell-side opportunities and sell-side only opportunities. We never once broke structure to the upside, did we? That's the one thing you'll remember from that little exercise. And when we come back to the S&P, you'll see that we never once broke structure to the upside. In other words, you were never looking for the buy trade. You were always looking for the sell trade. Now, that's got to be a huge, massive improvement to what you've been doing so far. So when we break sell side, we now know that when we break sell side, structure's now broken. The highest high that was traded at that stage becomes the top, and now everything is now sell side. It doesn't matter what happens. It doesn't matter how many turns or how many twists and how many times it goes up. So long as it doesn't break that line, and it hasn't broken this line, this is still a sell trade. The sellers will come in here. The sellers will come in here. The sellers will break south. They'll sell in here. They'll break back up. They'll sell back in here. And they'll go for the break to the downside. This is trading structure. Every single one of you has structure on your charts. It's got nothing to do with trend lines, because trend lines don't work. It's got nothing to do with moving averages, because moving averages don't work. It's got nothing to do with any of these other ideas that simply are looking backwards at something else. This is simply looking at the most current actual trade. Most current actual trade. Looking at where the buyers came in, looking at where the sellers came in, and looking at where the market makers connected. Now, obviously, this is a challenge series. But obviously, to challenge you guys to find these ideas, you've got to teach these ideas first. So therefore, the challenge isn't going to really kick off until we reach Wednesday's classroom and Friday's classroom, because you've got to know where these levels are. So the challenge is that when you come into the room tomorrow, you've been able to eliminate one side of your charts and focus all your attention on the other side. You've been able to eliminate the buy or the sell through to bottom edges or top edges. This is what the interns are taught. They're taught to eliminate one side of the market based on structure. In the early days, the interns are taught to sell the breakout trade, because that's how we get away from everything else. They're taught to sell the breakout inside the structure. So what do we mean by breakout? Well, it's up to you. A lot of people will think about breakouts as, for example, the Bill Williams type exercises of 2 fingers to the left, 2 fingers to the right kind of idea, 2 higher highs on either side, or 2 lower lows on either side. But the interns are simply looking at this from the idea that they want to try and reverse into a short trade. They want to be short during this structural sell-off. So in the very, very, very first stages, the intern simply draws a line off the low prices when we break structure. So we broke structure over here. The intern's job is now simply to draw lines off of every low fractal point. Does everybody know what a fractal point is? Bill Williams explains it best. All you're going to do is draw lines off of every low fractal point, and the intern initially, remember this is just an exercise, the intern will sell every break of a fractal. A good, clean fractal. In other words, the intern will sell here. The intern will sell here. Now we don't get a sell of the bottom edge here, so it doesn't break that sell. So you can see that the intern sells there and the intern sells here, and they get some pretty good outcomes from those trades. Now this is what we would develop into what is called the BSG squeeze, which is an old-fashioned trade from years and years and years, decades ago. And it is basically watching the before she goes squeeze was actually more based on order flow rather than price action. The order flow behind the BSG squeeze, which is very, very simple, is that as you get near an edge, all the buyers pull away their liquidity and then the price sells off through the level. What normally happens is it's a scalp trade. It's a scalp trade for 1s and 2s and 3-tick profits, which a lot of floor traders were obviously into at the time. It was very much a case of just making your couple of ticks out of the trade and getting out and saying thank you very much and doing it as often as you possibly can. There was no commissions, of course, except for the cost of your floor space, your license. So when we understand this, we can see that the floor traders will probably take profits a lot of the times when these trades happen, and the job of the interns is to try and get in a little bit before this line takes place, perhaps even just one single tick before the line breaks, with the objective of making 2 or 3 ticks on the break, getting out of the trade or getting their stops at break even and walking away from that. The success rate in these trades actually are incredibly high, because if you think about what happened next, the price rallied, came back down to the bottom edge, didn't break the bottom edge, and it created a new level just there. Well, that's an intern sell level. So that's another intern sell level, isn't it? So the price would have been another sellable opportunity just there, which then took us into the big level from previous. So there would have been a second intern sell there, but there was another one. You might be able to recognize in the background that there was a pin candle just here at 1604. So if I draw a line against that pin candle, you'd be able to recognize that that was also an intern's sell candle just there. Hard stop at the previous highs and simply working that short trade. So in other words, using the failed auction to get short. Well, think about the money that the interns just made on those sells. Remember, they've only taken the sells because we had the previous structural break. They've already eliminated the buy trades. So we're not teaching them to fade the higher prices. So the interns are not taking, for example, this top edge sell here until they understand exactly what's going on. They're also not taking this top edge sell here because they're commercial sells. They're commercial sells. You only take those when you know what you're doing. So the intern doesn't yet know what they're doing. They simply want to try and trade with structure. They want to try and trade with liquidity. Many of you have heard the concept of weak and strong liquidity. The concept that if we get strong liquidity and weak-handed buyers, you obviously want to go against the weak-handed trader, right? You want to kick sand in their face. You want to take their wives off them, if they're hot, of course. You want to take their wives off them. Who's the weak-handed trader in this chart? It's dead obvious, isn't it? The weak-handed trader is the guy that hasn't made any money. In other words, in a downtrend, the weak-handed trader is the buyer, always will be the buyer. Not even the big commercials are weak-handed buyers because they're simply in a position where they haven't made any cash. They will not defend a position against heavy selling. Why would you want to defend a position against heavy selling? You might as well get a better price. If there's that much selling coming in, you get a better price with bigger volumes. Let the price go through. So trading with that structure break is always going to be far more profitable than trying to trade against the structural break. So you can see that there's a number of opportunities. You can see the next intern trade after those sells have came in is, of course, drawing this low here. So we can already recognize that the next trade the intern would have done was here. And then we get another break to the downside, and the intern would have been able to make 2 or 3 ticks, no problem. And then we get another break to the downside here. And there's another intern sell. And you can see the price never takes out the highs, never takes out the highs at all. We get another sell, the intern makes another 2 or 3 ticks. Remember, it's not just about making 2 or 3 ticks. It's about making 2 or 3 ticks and getting your stop at break even on the remainder of your position, and the possibility that you're going to make a big, massive moonshot trade in this. If you wanted to argue about this one here, you can obviously argue in this. If you wanted to argue about this one here, you can obviously argue all you like, but there's a little pin rejection there. There's a nice sharp candle reversal. It doesn't matter whether you count it, whether you don't count it, but if you were counting it, that would be another sell just there. The last sell doesn't ever happen because the last sell would have been at that price. You can see it doesn't happen. Not at this stage anyway. So obviously, this is also into what we call an aggregation candle. An aggregation candle is just simply massive volume at an extended price point. So we see these aggregation candles all the time. In fact, in the classroom, we did an exercise on gold. The guys will remember it. It wasn't that long ago. It was just a week or so ago. We did a classroom on gold. I think it was, or oil, or S&P. In fact, I think we did all three of them at some stage, where simply we took all the price charts off and we simply traded aggregation. Interestingly enough, we made money simply by trading aggregation candles. Now, a lot of people say, but wait a second, how does the market maker make any money in a market like this? How does a market maker get to balance these trades? Well, it's all about a concept called mitigation. How do we figure out where mitigation is? Well, it's not ideal, it's not perfect, but it's good enough. The concept of mitigation is based upon the VWAP of the move itself. And all we do is we re-anchor the VWAP after mitigation takes place. Right? So let's do it. Inside your trading view, if you go into the second panel on the left-hand side, go down to the bottom, you'll find a thing called the anchored VWAP. Now, obviously, we've already recognized that there's a sell coming in here, but it hasn't broken sell side, so the market maker isn't in any difficulty. The market maker only goes into difficulty when the market sells, because obviously the market's getting longer. The market makers are getting longer and longer as the price drops. So the break of this trend came in here. We can see the breaker structure again came in here. So obviously that's when the market maker ended up with a net long position. So we go back to the swing high and we simply start VWAP. Now the reason why we start VWAP is because obviously one of the key aspects to this VWAP is very, very straightforward and very, very simple. When we know where the VWAP is located, we can start seeing where mitigation takes place. Now mitigation will always take place on the VWAP, because that's the average sell price, right? That's the average buy price. So usually when the price comes up to VWAP, we get this idea of mitigation. Now, why is that important? Well, many of you have probably heard of algorithms that trade the VWAP, but they simply don't know how to use it. Because a lot of people have the VWAP of the day on the charts, and that's it. Well, that's not the way to use VWAP. The way to use VWAP is to re-anchor every time you get an aggregation. Every time you get a mitigation, you start re-anchoring your VWAP. So in other words, we got a touch into the VWAP just here. That was that sellable opportunity here around about 1620. So what we do is we take the VWAP into where the touch took place. And we draw another VWAP. And we can see that the next VWAP, we get another little opportunity just here. See it? Right there. We get another touch of the VWAP again. And that's another sellable opportunity. Because now we're looking at this and we're saying to ourselves, okay, every time we get a lower low and we've touched into this, we've got what is called a mitigation. So obviously they've mitigated the risk. That's all it means. They've mitigated the risk. They're obviously heavily long in these drops. And when they get back up to the VWAP, they can clear their book. Do the exercise for yourself. You'll see what I mean. And I'll touch on that exercise before we finish up tonight. So all we do now is we pick up the VWAP again and we move it to the next point, and I'll get rid of these arrows, otherwise I'll just keep picking up the stupid arrows. We move it to the next point and we re-anchor it. As we re-anchor it, you can see that the price drops, and then we can see how easy it was for the market maker to get that mitigation into that trade right there. Now obviously it also comes back into this area here, which is a very, very significant level for us because it's the half-back trade area. So you can see and understand how this works. You can start seeing that now that we've got through the mitigation price, it becomes a bracket trade. And that means that we're starting to look at the possibility that the lows are now the lows, and we're now looking at the possibility that the commercials may come in, but we still haven't had any structural break to the upside. So we should still be short. Regardless of what you think, we should still be short. So when we go back below the VWAP again, there's another opportunity to get back in that short play. As we come down into the bottom edge, you can see that there was a little pin rejection, and then we sold off, and the interns would now be short again. Think about these trades, guys. You might be laughing at this intern's exercise and saying it's a bit basic, isn't it? It's a bit straightforward. Well, did you have all of these sellable opportunities? Did you make 100% winners during that phase? If you did, what the hell are you in this classroom for, right? But if you didn't, this exercise actually is showing some incredible tradable opportunities for the interns to lead the way into these narratives. As we get another fractal edge right there, you can see that yet again, another intern's sellable opportunity just there, quite straightforward. And as we get another break lower, we can see that the next pin rejection happens just here. Now, obviously, subsequent to that, we get another little pin rejection just here. And obviously, they're pretty much the same price. And obviously, that's another intern's sell trade right there. Pretty straightforward stuff, isn't it? Now, obviously, when we're looking at some R-squared ideas, we can see that the idea is to try and continue to sell with R-squared. The idea is to try and stick with this as a narrative and to start recognizing when R-squared is no longer supportive of these sells, so that we stop selling at the right time. Into the bottom edge, of course, the right time starts to diverge into those low prices, and we can start seeing that perhaps selling into the low prices is no longer maybe the best opportunity to make money. Now, obviously, what happens is you can see that the price did rally from that price. It became quite obvious. The lower low, of course, gives us another idea about where we should be trading. When did the market structure change, though? Great question, because that's the question you should be asking. Where did the market structure change? Well, when we got this lower low break on this little candle, the previous low was here. So the market structure break must have been the break of that high, surely to goodness. Well, that's the answer, isn't it? That's where the market structure broke. So now we highlight this as a structure break, we highlight this as the swing low, and we start considering the probability of buying into this. Now, this is early. We want to check this with R-squared, but this is the structure. The structure is as pretty much as objective as we can make it. The break of structure allows you to start thinking about doing the interns exercise now purely on the buy side of the market. And obviously, as the price breaks back down again, we're looking at this key level here. You can see there was a little pin rejection in here that you might have fancied to try and get in as early as possible because it's obviously very early to the party. But it doesn't matter. It comes in here or it comes in here. It doesn't make any difference because they both made money. They both broke to the upside. And then you can see a structure break there, which happens to correspond with the higher high up here. Now, that would have given you a couple of trades in exactly the same place there. And obviously, that gives us a new structure high, which never breaks. The price breaks down. We get a small short-term break of structure here. And what happens? The price keeps dropping down. The price keeps dropping down. The price is still bullish. It's never changed. Now, obviously, the commercials may well be buying these phases, but that's not important for the interns. What's important for the interns is to recognize that these phases are going to be buyable opportunities should it reverse back out of these areas. So when we come into this area here, we can see there's another buyable opportunity just there. When we come into this top edge here, we can see there's another buyable opportunity just there. Did those buy trades make money? Did those buy trades make money? Yeah, those buy trades even made money, didn't they? So as a local in the room at this stage, those buy trades made money and they were in line with the commercial structure. The commercial structure was bullish. The prop desks have obviously came on board because we're now getting buy opportunities away from the bottom edges. So therefore, there is now an element of HFT buying coming into this as a structural development, right? We can see it. It's not made up. It's not made up, is it? It's crystal fucking clear. So we can start recognizing that this is crystal clear. We can start seeing that this storyline at this stage is still bullish. Now, obviously, it's up to us to recognize any changes. And what happens, of course, is that we come back down into the bottom edge. We still haven't broken any other top edges. We haven't broken any structures. There hasn't been any other trades. There they are there. You can see them for yourselves. You can simply just keep drawing in the ideas, watching for the trades, and seeing what happens. And then we break structure. That's it. The buying is temporarily at least finished. We can start to recognize that the buying is temporarily finished and we should be trying to be short. Now, obviously, it's going to be difficult to try and figure out exactly where the sell trade came from for this little bit of a sell here because they're all pretty much the same price. I think most people would probably try and go back to this one because obviously it's got the big volume attached to it, the big volume sell-off. It makes the most sense. So obviously this was the break of that structure, and you can say, right, well, the highest high during that period, it's either going to be this candle here or it's going to be the top edge here. There's a little bit of subjectivity in there, but you can obviously make it more objective if you want to use the breakouts of the structures or the closing of the structures. So what happens? So obviously inside of this structure, the next sell would have been here. We still didn't get a sell. And then, of course, you might have been able to get a little sell here. That did pay out. You would have been able to make some money on that sell. Not much, but you still have been able to make some money. You might be saying, this is a very small sell here. 35.75 traded at a low price, guys, at 32.75. That's 3 points. That's $150 in 1 or 2 minutes. That is not chump change. That is not chump change in anybody's book. So when you see that sell there, it doesn't trigger. When you see that sell there, it doesn't trigger. And obviously now we're just up to date on the right-hand edge of the charts. There was no other sells. So when you look at this, we've just taken a trade from the top edge of the markets. We've only sold, and we've only bought using the Intern's exercise. We've only sold, and we've only bought at the worst possible price. The breakout bloody trade, the worst possible trade in the book. And yet we've made money, so long as our expectations are manageable, so long as our expectations are manageable, and so long as our execution is pretty accurate, pretty fast. Every single trade made at least a stop at break even, didn't it? Every single trade was able to make 2 or 3 ticks, stops at break even, worst case scenario. Well, there was a lot of trades. You see that we drew in pretty much every single line. There was 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17. There was 18 trades. Every single one of them had an objective trade entry. And there was 18 winners out of 18 based on a very simple stop, very simple target price, a simple target price of 3 ticks and a stop at break even. You had 18 winners in a row for 3 ticks. Say 4 ticks, $50. 18 winners in a row, $900 scalping 1 lot. $900 scalping 1 lot. That's a pretty good profit for a local per contract. Pretty good profit for a local per contract. And imagine you're trading a 5, a 10 as a local. You're starting to see that you're making maybe $7,000, $8,000, $9,000, and you're obviously not able to simply just take one trade out of these ideas. You're able to take 4 ticks profit, but some trades you're actually able to hold for perhaps $1,000 per contract. So this sell you might have been able to sell and then hold the big drop, and the sell came from 70s, it got down into the 50s. That trade is $1,000 in its own if you were able to get your stops at break even for part of your trade. So the Intern's exercise sounds very, very silly, very basic, very straightforward. And for God's sake, I've been trading for X number of years, and you're expecting me to be an intern, you're expecting me to start all over again. Well, perhaps you've got an awful lot of bad habits. Perhaps you're one of the guys that's constantly selling top edges and finding your account dwindling away, or trying to buy the bottom edge and saying, why the hell does the price not go up? Because it's designed that way. It's designed to put you under as much pressure as possible. So let's recap the structure before we go into the close here. We look at the value. You can see the value is never bullish. You see that? The value never went bullish on these 2 candles here. So obviously as a commercial, I'd be selling into their buying. I would be selling into this pullback phase here. That's what I would be doing as a commercial seller. I'd be selling into that value break to the upside. But that's what we call level 2 liquidity, and we'll cover that when we just wrap up this process so that you've got the terminology right. Into the bottom edge, you can see that the value is now divergent on this break. There's obviously some commercial activity on this buy trade here. There's no way I'd be selling this one. No way I'd be selling this one. I'd now be trying to buy into this, but you can see even when the commercials are buying from the interns are still able to make some money on the downswing. So as a commercial, I'll be buying into these red lines. I'd be buying this break lower here, and I'd be buying into that liquidity and driving the price in line with that commercial narrative. So you can understand that the big commercial trade of the day was this big short. The sell on these pullbacks was a big commercial trade, and at the closing bell, the buys into the lows was the commercial trade. Very, very straightforward. So let's summarize before finishing up for today's classroom. I said we would try and keep used to an hour each session. We've got 4 of these types of sessions to get through, Monday, Tuesday, Wednesday, and Friday. So obviously by the time we reach Friday, we'll have covered this again and again and again to make sure you're absolutely getting it. So let's summarize, guys. Let's summarize. Trading is about understanding who trades in what location. It's about trying to get away from fading the market, because retail traders are rank rotten at fading the marketplace. And the reason why they're rank rotten is because they're trying to mimic a commercial, except a commercial is trying to put 1,000 contracts into the bottom edge. They are averaging into a bottom edge. You have 1 contract or 5 contracts to put into the bottom edge. Your timing has to be impeccable. And most people's timing, professionals alike, is not impeccable. You're lucky if you bottom tick the price. And yet you're constantly trying to bottom tick that so that you've got the big kahunas right. So you can go to your other buddies and say, bottom tick the oil today. That's all right, but the other 99 buy trades on the way down all lost money, right? So yes, you bottom tick the market. You'll always bottom tick the market. If you just keep buying the lows, you'll eventually get it right at some stage. So stop trying to be the guy that bottom ticks the market until you learn the basics. Be the guy that creates the bottom edge. Be the guy that pushes Goldman Sachs over. What a great feeling, pushing Goldman Sachs over. And that's what's happening. Push them over and just keep pushing them over. So let's just finish off by understanding the exercise. When a pivot price is created anywhere, we call this a level 1. Anytime we get a pivot price, we simply call this a level 1. Now, obviously, when we've got a level 1, that represents 1 level of liquidity. So obviously, the idea is price will trade towards liquidity. That's the idea of the markets, correct? The idea of the markets, you've all heard it, is to facilitate trade. So the price will trade towards liquidity. So above level 1, there are buyers, there's stops, there's liquidity up here. So the price will trade towards that. When the price breaks higher and it breaks off that level, this is another level 1. It doesn't become level 2. It's just another level 1. So that's where the liquidity is at, right? That's where the liquidity is at. When the price breaks another level 1, the one thing we're always interested in is when the price breaks back inside level 1 and takes out the previous pivot. What is that? Well, that is a level 2. So this level 1 turns into a level 2, and a level 2 is very simple. A level 2 can be classified as possibly aggregation, possibly commercial selling. So into this level 2 here, we now have the possibility of recognizing a commercial seller in place using simply price action. Simply using price action. Now remember, when I showed you the S&P, what did I draw? Do you remember what I drew? We were talking about the sell trade and the 2 bottom edge buy trades. What did I draw? Well, obviously we'd drawn the level 1s, which was the red line, right? So the first thing we'd drawn was the red line across our charts here, and then we recognized this box. Well, what is that box? We already told you what that box was. That box was commercial selling. How did we know it was commercial selling? Because we looked at our R squared. When we looked at R squared, we were able to recognize that there was a lot of commercial value for the short trade up here. So when we got an L1 into an L2, and we only know it's an L2 when the price breaks back inside this area, don't we? So when the price breaks back inside the area, it becomes an L2, and you'll see us drawing a box around that L2. Into the bottom edge, you'll see that we took out the low price, we drove back into that low price area, and the value was starting to become bullish. So that's a commercial buy level. It may be a commercial exit, but whatever it is, it's a commercial trade. And then obviously we got a level 2 here, we took out a level 1, we drove back above the level 1, that's another commercial level 2 trade. So this is a very, very simple way of marking up your charts. This is a level 2. Now obviously at this point the market is still in a bullish structure. we can understand that at the present moment it's a bullish structure. Now, obviously, when it breaks this level, if you'd assumed that that was a pivot price, that structure has just broken. So that level 2 becomes even more important to us. The structure has now broken. And obviously what we're going to be looking at is what happens next in these areas. We're going to be watching this as a storyline, and what we're hoping to see is that is obviously a level 2 right there, isn't it? That's a level 2, and this is going to be a level 1 target. So this becomes a level 1 target right at the bottom edge here, doesn't it? So that's a level 1, and this becomes a level 1 here. So we're targeting level 1 liquidity, aren't we? This is the point. This is why it becomes important that we start targeting into these level 1 liquidities here. So obviously this is a 2 point, this is a level 2, which is a commercial sell. But obviously following a commercial sell, this is when the interns come in. Following that commercial sell, the intern will come in here and the intern will come in here. Do you see where the trades are? It's actually very, very objective. It doesn't matter whether you're using line charts or simple candlesticks or whatever. It's a very objective way of starting to analyze and develop out some trade ideas on the charts, and it actually works. It's an amazing breakthrough for some people to release the pressure of trying to call top edges and bottom edges. That release of pressure is an incredible burden that's lifted off an awful lot of traders. I don't have to call a top edge. Let somebody else be the guy that stops the market. How am I supposed to call a top edge with 5 contracts? How the hell can I stop the market moving? So obviously all you're trying to do is avoid calling top edges. The top edge is already in, and now what you're trying to do is join in with the process. There's your next level 1 just there. We can understand that that's the next level 1 here, the next level 1 here, and the next sell right there. There's the next sell right there. And obviously this is part of that process. Now what happens in the interns is that we get them further and further higher than the level 1. We try and get them in before the break. It's called the BSG squeeze, and it's called the tipping price. So what we try and do during the interns exercise, during the interns process, is we try and get people as close to the level 2 without being the level 2. So we try and get people in here. We try and get people in here. We try and get people in here. So that's called the Heisman trade. So we've got names for each of these trades. The trade coming back inside the level is called the Heisman trade. The trade about halfway through the trade area is called the tipping price trade, the TP trade. And the trade at the bottom edge before the break lower is called the BSG squeeze. 3 trade entries, 3 opportunities to get short. 3 opportunities to get short at different prices depending upon the size of the range that you've got, the amount of value that you've got developing on your charts, but you've got to be able to first of all recognize these areas. Now obviously when we start drawing out market structure in the second class tomorrow, we're going to start drawing and narrating our charts properly, but we've got to start somewhere. The first thing we always do is we start with level 1s and level 2s. Now one of the things is, you know, well, how good is this whole process in terms of why should we listen to this as a process? Why should we pay any attention to this as a process? And I wanted to, you know, if you want to disappear off, then disappear off. But I want to show you a couple of some of the trade ideas that we've been developing over the last week or so. I've been taking some screenshots. They're all time-stamped, so you can see what we were talking about in certain locations. But in terms of the exercises today, we're finished. But for tomorrow's classroom, we're going to go over these, narrate the charts, and then we're going to start developing out the challenge on the Wednesday and the Friday to let you guys go piece by piece, swing by swing, narrating the charts, and then checking your understanding on the Wednesday and on the Friday to make sure you're correct in where you're trying to look for those trades. That's what we're going to develop until we get to the right-hand edge of the charts, and then we can see if we're up to speed. So we'll take the last hour or so of trading, and we'll start looking at where the trade narratives will evolve from. But let's take a look at why we, why you should bother paying any attention to this. Let's take a look at what we've been seeing on this trade idea, what we've been seeing in these areas. Now, why is this important? Well, because obviously you've got to have confidence that what you're seeing has any value whatsoever. And I promise, as I said, we're not going to take a long time here, but I want to just show you some of these trade ideas. This is Max on oil. This is on the 26th of July. You can see some of the Max trades, and Max is based on the concept of R squared. So one of the things that we're going to be releasing in the next short while, we've had problems because of COVID and personal reasons. We've had an awful lot of delays in the whole process. We hope to have this available for this classroom, but unfortunately we're behind the curve, and that's my fault, but it is what it is. Family reasons meant that we were always going to be a little bit behind. COVID, of course. But you can see where the sales are. You can see where the sales are and where the buys are. So these triggers are worth thousands. You can see the high price here was at $98 a barrel. The low price was at $95. That sale was worth potentially $3,000. So this is one way we can get into trying to find those commercial sales earlier. So this is one way we can get into trying to find those commercial sales early. We can see where the commercial sales are, they're red. We can see where the commercial buys are, they're blue. And therefore doing the interns exercise as soon as we see those sales, whilst you might not sell the sell, you know that it is a sell because it's got commercial R squared, and we can take advantage of that, right? We make a lot of money on those types of trades. So that's something that you can see as reality. When we look at this one, this is going back to the 26th of July as well. At 2:20 a.m. in the morning, you can see we gave you some key levels here, 39.64, 39.66 floor level. Levels to note, talking about Goldman Sachs' Fed analysis, the 5-year inflation break-evens has shown demand pressure back on a small build, reducing the Fed's ability to sound too dovish at tomorrow's meeting. June supply has fed dovish, and had it continued, we would have been looking for them to ease off the gas, but that didn't happen. Hence the reason why we said the word pity. This was at 10:59 on the 26th of July. Why is that important? Because obviously at that stage you can see that at 11 o'clock on July, we'd already talked about the Fed not having the ability to be dovish. Well, if anybody understands fundamentals, they'll understand that means we're bearish the S&P. If you don't know what that means, you really need to be in this classroom, because you need to know these things, because that was the driver for the day. The market is bearish. So think about all those sellable opportunities you could have had off of the price of 39.64, 39.66, which you already knew about. All that selling was at 39.60, 39.62. Think about all those breaks. Even with the interns exercise, you would have made a small fortune. And it was a small fortune. 39.60s traded a low price of 39.20s for 40 points. $2,000 per contract over the course of the next few hours, just by doing the interns exercise and being able to read and understand some basics about fundamentals. That was the fundamental driver of the day. If you don't understand that, you really need to understand it if you're going to be successful as a trader. Oil. We talk about RGLs. These are what we call volatility expansion trades. When we understand the concept of volatility expansion, we find a specific price and we look to expand the volatility on the markets at that price. Oil, 2:20 a.m., 26th of July, we've got a volatility expansion of 96.95, 96.80, so a 15-tick range. 15-tick range, okay? So what does that mean? Well, we mark it on our charts, 96, 95, 96, 80. You'll see that on our charts we had 96, 95, 96, 80 in certain areas, and we start looking around those trade areas. We start looking for opportunities. We start looking for the short side, and we start dealing. Now, obviously, one of the things that we started to see was the dollar driving oil higher. However, the supply curve is still visible, with supply around $93 a barrel. Commercial sellers prior at 97.30, 98 evens. Now, you might be saying, so why were you selling into the higher price? Well, we had another reason to be selling into 99s, but obviously we had a valuation of 93 on oil at the stage. We were coming into the London Brent market open, and obviously at 9 o'clock in the morning, we're telling you, we're working on the short side. 9 o'clock in the morning, 10 o'clock in the morning, guys. We're working the short side with a target price of $93 a barrel. We're selling $99 a barrel. We sell off, we break the $97 level wide open, and we end up down at $95. That's a $4,000 per contract win for one day. on one contract. Now, why were we trading on these areas? Well, because obviously we'd called a couple of ideas, we had a couple of narratives, and again, it comes down to the definition of what's driving your markets today. Oil, key dealers level, 9:38 a.m. on the 27th of July. The key dealers level, something we teach in the classroom. Key dealers level, 96.35 and 96.15. Draw it in the charts. Look at all the sales you had after the call. Take a look at the bottom edge. You'll see the date, it's 27th of July, 12 o'clock midday. This is at 9:30 in the morning, 27th of July. That shaded area at the top of the right-hand side of your screen, that is that dealer's inventory level. It's sell side below, buy side above, guys. So you can see that we're selling away from it, selling away from it, selling away from it, selling away from it, selling away from it. Eventually, we go 96.20 to a low price of 94.20 for $2,000 per contract short oil in the afternoon session. $2,000 per contract from that level that we'd already told you about. Sell side below, buy side above. In other words, we're telling you what side to eliminate. If it's below this level, you're eliminating the buy side of the market as much as you can. So in other words, you're working the sales. You're working the sales as a fader. You're working the sales as an intern. You're working the sell side only. Sell side only. Eliminating one side of the marketplace. It's not hindsight information. This happened. We were still selling at 2 o'clock in the afternoon. In other words, for 5 hours, we kept selling the same top edge. 5 hours of short accumulation. A massive commercial short position was built up around that 5-hour period, so that when the sell came in, we made a fortune. As we move forward, we can see that we got an easy short off of that top edge again. Very, very straightforward. Very, very simple trades at 2 o'clock in the afternoon. That's the sell that we've just touched on, guys. It's one of the sells. And again, this is just about trying to understand the idea that when we get into position to sell, there's going to be some keys to getting the short done. The massive increase in volumes, the logic about what that volume is, the refreshed order book coming in behind, the Baltic kicking off in that area. Selling against that means that we can run literally 4 or 5 tick stops on these trades. That trade went for $2,000 a contract with a 4 or 5 tick stop, guys. 4 or 5 tick stop. You can't beat it. It's unbelievable. Bonds. 2:27 a.m. 26th of July. These times, by the way, are all London time. Okay, so 2:27 a.m. 26th of July. Macro. Value on the UB at 158 handle between the 2s, 10s and 30s. The belly's against us, however, at the moment. So when that lines up, we can play the long side. Inflation break-evens are against the deal at the moment, so we're looking for the London fixed income open to try and buy into this. This is at 2:27 a.m. The London fixed income market opens at 7 o'clock, 8 o'clock London time. So in other words, this is 5 or 6 hours before the buy trade. Long at the London Open at 157.02s. You see the time of the charts, you can see the date on the charts, you can see the time, and obviously what happens is we simply bought the bottom edge. As we tweeted 7 hours earlier, we bought the bottom edge. And obviously we had a target price of 158. We'd already valued bonds at 158. What happened? We didn't just trade 158s. We traded nearly 159s eventually. The value changes as the day progresses. But again, we call this hours in advance. So why should you listen to us? Because you can see the quality of these trades. That trade was worth $2,000. We showed you the oil trade from the day before was worth $2,000 on the short side. From a call that's already time-stamped. You don't have to take our word for it. It's time-stamped. I'm not going to mock up a bloody timestamp, for God's sake. The guys in the room who are in this know these do not get changed. We can obviously look at many different trades. This is just a look at some R-squared value in the euro dollar to show some commercial value in the euro, and that trade went for 140 pips. You can see the green line is commercial value, that's R-squared, and selling into the top edge was a no-brainer. So it just gives you some ideas about this narrative. And all we've done in this chart here is to try and look at that structure we've just been talking about. The accumulations, the cross sellers, the idea of selling into these crosses, the idea of accumulating on upticks, and then comparing the theory with the actuals. This is a great example of a bit of business here. This is oil again. We've just talked about oil. We're talking about the market makers building short inventory. We've got an inventory level here on the 27th of July. The price went higher, came down, built value, and obviously it built value, informed sellers, market maker wants a piece. We draw the level on the charts, and the sell away from that was worth thousands of dollars. Let's get into another idea. This is just the same as what we covered in the previous classroom, this idea about selling into higher prices, this idea of the delta diverging from the price action. But it's important that you understand that we don't teach a style of trading. We teach trading. We teach about order flow. We teach about fundamentals. We teach about technicals. We teach about delta. We teach about volume. It's not isolated to one piece. There's many good education courses out there, but they focus on one thing. In other words, they leave you missing so much of the jigsaw puzzle, you can't make head nor tail of it. So when you start a look at the marketplace, you're left with a chart that looks like this. Where do you start? The right-hand edge of a chart is incredibly scary. We start by coming up with some ideas about where trade location is, some key levels, some key references that we can look at when we design some trades around these key references. So where do we start on that chart? Where would you start? Well, we've obviously talked about structure today. What about trying to recognize some of these key ideas? Now, you might be saying, but that didn't have a key structural buy at the bottom edge. The structure was sell side. Yes, you're right. Good spot. These buys, however, were all structurally perfect. How did you get these amazing trades? How were you able to take advantage of these amazing trades? Well, you can see that one of our S&P keys of the day was 39.54, 39.56. You see it was highlighted by 2 M's, which means major, major. It's not just a major, guys. It's a rank above the major. It's a major, major, or a mega major, right? So we've obviously got 39.54, 39.56, major level, 11 o'clock the day before. 11 o'clock the day before, guys. Not after, not in hindsight. And obviously, if you look on the right-hand side of this screen, you'll recognize the price was 39.54, 39.56, where these 3 blue lines are. We knew that this was a key price, 39.54, 39.56. It's buy side above, sell side below. So that what happens? We come into the US cash open, and all of a sudden it's buy side above. It never goes below. It never goes below. It never goes short. But there's more. How did we know to sell so aggressively into the top edge up here? How did we know that the buy trade was finished? Because it doesn't seem to have broken structure. It doesn't seem to have broken structure for the interns to get that short trade on the books. So how were we able to get into that short trade at the top of the markets? Well, the simple answer was R squared. If you look at how the market evolved into an R squared narrative, you'll be able to see that when the curtain finally gets pulled back in these trades, you're no longer left wondering why we were selling the top edge anymore, were you? We can see that there is a huge commercial value getting short S&P into the high prices. There was some huge commercial value being consistently buying into those pullback lows of the early US session in here. We never once went structure short. In due course, you start learning that trading is not about structural breaks, but about structural breaks in context with commercial activity. It's not as simple as structure, but structure is a great starting place to start recognizing that the market cannot go into a buy trend unless it breaks a structure. And then you simply go with the structure, hence the reason why it's the intern's exercise. When we see just how much value is in this, and you're sitting there using your stochastics, and you're sitting there using your MACDs, and you're sitting there using your RSIs, you can see how useless they are. It's got nothing to do with any of those tools. Nothing. Now, there is a use for these types of mean reversion type trades. There's a use for these inside of certain spread parameters, but that's a different question altogether. This is the only thing that's real time on the right hand edge and is updating 24 hours a day. We're able to look at various R-squared narratives, recognize what the R-squared is, trade the R-squared, make ourselves an awful lot of money. Now, these screenshots, by the way, are just randomly selected as the days progress. You'll see that we're progressing in terms of days. We're on the 27th of July here. And obviously, we can start clicking through some of these narratives. Take a look at this one here, guys. This is the value of knowing what R-squared is. This is the value of knowing what structure is. Take a look for yourself at these two tweets. Look at the timing of these two tweets. 11:05 on the 26th of July. We've obviously got some keys, and our key, as you probably already remember from an earlier message, was 39.54, 39.56 buy side, right? So we've already given you that 14 hours before the US cash open, 15 hours before the US cash open. You already know about this price here at 54.55s. But it's not just that. Look at the tweet 1 minute before the cash open on the 27th. You see it? 1 minute. It's time-stamped on Twitter for you to see it. 1 minute before the cash open. S&P, sentiments positive ahead of the cash open with the GP longs at 39.55 if the value stays in at the open. In other words, the sentiment is positive. We're buying the US cash open, and look at what happened to the trade, guys. The cash open, the price went up, tested, went up, tested, and then just about 3 o'clock, the market exploded north from 39.55 to 40.45. 90 points higher. 90 points, guys. $4,500 per contract. 4.5 grand per contract, and you're wasting your time trying to figure out whether the market had a Fibonacci opportunity, a Fibonacci extension, or a stupid dumbass Elliott wave pullback of an ABC correction. Do you know what I mean? It doesn't make any sense. It's not being talked about on the floor of the exchanges. It doesn't have any value to even waste any time on it. Does the market move in waves? Yes, it does, but they don't have anything to do with Elliott. It's all to do with the market makers, it's to do with value, and it's to do with order flow. Take a look at this tweet here at 10 o'clock on the 28th of July. Smaller ranges post-Fed, no news drivers to add to the picture. Currently working the shorts in line with the macro value. 10 o'clock, guys. Here's the right-hand side. You'll see at 10 past 10, you'll see the short areas. I am telling you, I'm currently working shorts at 10 o'clock in line with the macro value, okay? So you can see where we're selling into the highs, we're selling into the highs, we're selling into the highs. Shortly after the tweet, the prices dropped from 99.50s to 99.20s. Another $300 winner per contract. If you'd followed into the tweet, the same narrative, the same storyline, it's over and over and over and over again, guys. Oil, RGL, again, 97.40, 97.25, 97.40, 97.25, buy side above, sell side below. The price goes from 97 up to $99.50. There are thousands of these, literally thousands of these. Take a look at this one here, and I'll leave it at this one, guys, because there's a lot more we could cover. We're probably bored rigid looking at these by now. 13 hours prior to this market, look at this, RGL, 40.22, 40.24. The RGL is out the day before, okay? The RGL is available the day before. Look at the S&P keys, the day before, 40.07, 40.100, right? 4.007, 4,000, M, major level. This shaded area is 22 to 24, and this shaded area here is 44 evens to 44.07. Look at what happened. The price sold into 40.22s. 40.22s. R squared is falling. R squared is falling. at 40.22s. It's such an easy sell, it's almost a blind man's game here. Sell side only. The price drops, surprisingly enough, all the way to, look at the right hand side, 40.004. See it? 40.04, guys. 40.04 at 10 o'clock the next day. In other words, something like 10, 11 hours later, after you've already seen the levels, after you've already got notification of the levels, you're able to buy off that 40.04s for a move that went up another $500. A $1,000 sell, a $500 buy, that's $1,500 a contract trading off of these commercial levels. Now remember, the idea is that if you don't want to fade these commercial levels, you're at least recognizing that there's a commercial level there, so you're not having to wait for structural breaks to get the short trade on. You can actually sell the Intern's exercise from these levels if we stay below these prices. So instead of having to wait for the price to then drop through a commercial structure, pull back into the commercial structure, and then start working the sell, you're literally selling from the gun. You're literally selling from the time you touch a top edge. So in other words, all of these sells here at 1 o'clock in the morning in the Asia Pacific session, all of this top edge sell here, you're able to get into that Intern sell phase there. Coming into 7 o'clock London Open, 8 o'clock London Open, you're able to join in with the Intern sell for that sell. And then on the retest, you're able to join in with these Intern sellable opportunities. And once we've touched the commercial bottom edge and it stays above, we're then able to enjoy the buy side narratives as an Intern, as an HFT, as a prop desk. In other words, we're telling you where the commercial levels are before the commercial level even gets to that price. Now, as I said, these things go on and on and on and on. This is still only the 28th of July, guys. This goes all the way up to today's markets when you start seeing some of these tweets. The guys will tell you in the room, we've been forecasting and we've been tweeting, and I could show you about a dozen tweets where we told you that oil prices were going to collapse. In fact, I might have one at another at some stage during this. I'll see if I can just scroll quickly through and see if we gave you this idea of oil selling coming into the markets. And there's a lot of trades that we could obviously highlight that we simply look for the big sell-off on oil. We were selling oil at $103 a barrel, traded below $90 the last few days. $13,000 sell-off, and we called every single step of the way. Short developing, you can see that at 1:33 p.m. on the 1st of August. Short developing, 1:33 p.m. Look at where the black box is here. 13:32, right? 13:32, which if you know the time is 1:32 p.m. 1:32 p.m., 1st of August. Short developing. We're hitting the offers, right? We're starting to get into that offer watch. We are starting to watch that uptick. We are selling. We'd already told you about the idea of a sweep into 93. This was at 11:30 p.m. from the day before. Think about it, guys. This is 11:30 p.m. the day before. We're looking at that macro supply for a sweep into $93. It's trading $97 nearly. It's $4,000 away from that price. And we're telling you it's going to sweep $93. And that we don't just tell you it's going to sweep $93, we tell you that we're now looking for that short trade at 1:33 p.m. A few minutes later, the sell comes off $96.50, and about an hour later, the price is trading $93.60. All of a sudden, you're seeing a $93.60. All of a sudden, you're seeing a $3,000 sell-off based on the fact that we said it would sweep into the 93s. It did. We told you that 12 hours, 13 hours before it happened, which we did, time-stamped. And we not only told you that, we told you when we were selling it. And the accuracy of that sell was pinpointed to literally a couple of minutes. Literally a couple of minutes. Short developing offer watch. Boom. Straight into a sell. And down she went for nearly $3,000 per contract. So are we in a good position to be able to tell you about this stuff? Sure. For me personally, I've been trading for, I hate to say it, but 40 odd years. 40 years. I've been on the IPE platform, floor trades. We've been doing the FTSE floor. We've done most of the time in the back office trading the Deutschmark. We traded the Deutschmark for one of the big English banks. Predominantly traded Deutschmark when it was around, of course, and we traded the Deutschmark crosses. But we've been on the IPE exchange. We've been on the floor of the FTSE as well. And for that reason, of course, 40 years of experience of making mistakes, picking yourself up, finding the next opportunities, and trading into these narratives, picking up on where the biggest problems are for retail traders, trying to understand a little bit about retail traders' problems in terms of where they trade and how they trade, trying to provide some fixes for those things. I trade not as a local, but as a commercial, taking commercial orders, working commercial orders, trading as the commercial desk on the bank, trading for the outright, almost the prop desk of the bank, but in the commercial sense. We know where the commercials trade because we've done it. We know where the locals trade because we've done it. We know where the algorithms trade because we design the most of them. We've been involved in a massive number of neural nets going back into the 80s, coming into the 90s. We've been involved in a lot of neural net programs with the Department of Trade and Industry in the UK at the time, developing the technologies associated with neural net programming way in the early days. So using all of that knowledge, you can see that we're getting some massive trade calls spot on every day of the week. Not just the big trade calls, not the big scenarios, but the micro world of pinpointing the exact turning price in the markets. If this appeals to you, then obviously it's up to you to keep with us during this whole process, but to develop the basic skills of generating an edge. And tomorrow we'll obviously go into more detail because we'll obviously go back through this level 1 liquidity, level 2 liquidity. We'll start narrating our charts so that when we drop the charts, we're starting to put the right things, the idea of where the measures come from, the concept of capping the price, the concept of measures, and from that, your edge is starting to grow. Slowly but surely, you're starting to get an edge. You've already seen a massive edge today simply by recognizing the break of structure. We had 18 S&P trades. Every single one of them made a 3-tick or a 4-tick profit and a stop at break even. Every single one of them was able to make at least that $50 per contract and a stop at break even on 18 trades. It's enormous. It's enormous if you are willing to put in the work, if you're willing to just bear with the process without having any preconceived ideas. Just come in with your cup empty and let us give you an opportunity to fill it with information that is actually usable, information that the locals know about, information that Charlie D talks about, the transition trading. And that's what we're going to start getting into in day 2 when we come back into the classroom this time tomorrow. We're going to finish off with that. I know we're trying to get through a lot in an hour, but obviously the first two sessions will be simply more of a learning session. And then when we get into day 3, which is going to be on the Wednesday, we're going to be doing more of the challenge, which is obviously taking a bit of chart on the right-hand edge of the charts and getting you to start drawing in these ideas, start using some of these techniques to find where the level 2s are, where the level 1s are, trying to understand where the volume becomes important, this idea of looking at some of the delta narratives so that we understand this idea of cap buyers and cap sellers and order block buyers and sellers. We're using some of the terminology that's common in the retail space so that you understand what we're talking about. We're going to finish off with that. Thank you very much for spending your time with us tonight. Join us tomorrow if you want to learn a little bit more. Same time, same place tomorrow. I'm going to say thanks very much. I'm out of here. In the meantime, ciao for now, guys.